this, as you know, is a webinar on how to increase your profits with an investment trust. I'm Jasmine Birtles. I run MoneyMagpie, and this is a MoneyMagpie webinar. And as you know, we like to bring you ideas for maximizing your investment wealth. And at MoneyMagpie, we are fans of investment trusts generally, as they do offer a greater opportunity to make money than many other types of funds. And today I have on my expert panel 3 people who know a lot about investment trusts, and they can give us answers to pretty much any question you have. Now, do remember that you can either raise your hand using the reaction buttons, or you can just put a question in the chat box. I find people tend to put a question in the chat box. So just to introduce you first to our expert panel, firstly, we have Stuart Gray from Alliance Trust. Stuart, say hello.
Hi, Jasmine. Hi, everyone.
Hello. Good to see you. Now, Alliance Trust is an investment trust with a very impressive record, particularly for its consistent dividend payouts. And Alliance Trust is also sponsoring this webinar, so we're particularly grateful to Stuart and his team. And we also have Moira O'Neill, who is an investment writer with the Financial Times and the Investors Chronicle. Say hi, Moira.
Hello, everyone. Hi, Jasmine.
Hello there. And we also, I'm very pleased to say we have an economist. We have the economist Vicky Pryce here, who can give you answers on all sorts of things to do with the economy, the global economy, those sort of questions. Say hi, Vicky.
Hi, and just to stress that I am just an economist rather than an investment expert, but there we go.
I like just an economist. I'm always so impressed if I'm described as an economist, which occasionally they do on like GB News or Talk TV, and I'm going, no, I'm not clever like that. No, but I think yes, being just an economist is great. So do come up with any questions you like on investing, on the economy, on the global economy, whatever is of interest to you. Now, at the moment, I can't actually see the chat room, but I think as soon as somebody does come up with a question or something, I will probably see it. Or if I don't, Izzy, you need to let me know what's going on, because yeah, I would like to see what the questions are if possible. So I'm going to start the ball rolling with a few of my own questions. So we'll just talk about generally about investment trusts to start off with, because I mentioned that investors can get better returns with an investment trust than they can with potentially an open-ended type of fund. So Stuart, I'll start with you, as you are the expert on investment trusts. Why is it, do you feel, that investment trusts can do better potentially, and sometimes worse, let's be honest, than open-ended just investment trusts?
Yeah, as you say, they can do better or worse, but I think the structural advantages of an investment trust over a more an open-ended vehicle are a few different things. I mean, firstly, and probably the main one, is that they can use leverage. Obviously, that's got to be sensibly managed over time, but by virtue of the structure itself, they can borrow money and they can use that money to enhance your returns. So assuming that asset prices go up over time, over long periods of time, added leverage should increase that return over and above what you'd normally get in an unlevered fund on the open-ended space. So that's...
When you say leverage, just to make it a bit simpler, when you say leverage, you mean you can borrow money and use that to invest in it?
Exactly, yeah. So the investment trust, the investment company itself, borrows money against the assets that it holds, and it invests that money alongside all the other assets of its shareholders. So that additional capital basically is used to generate extra return over and above a strategy with no leverage.
Because the idea, to me, the big thing about investment trusts is that they are actually companies as well. Moira, do you find that this is an advantage, that it's a company? So potentially, if the fund does really well, then the company's going to do well. So you've kind of got two lots of growth there.
Well, I like to think of investment trusts as companies whose business it is to invest on behalf of the shareholders. So it's like buying a stake in a company that's going to grow your money, your investment, for the long term, or produce income from it for the long term. And yeah, that structure, I think, is helpful. You buy and sell them like other companies on the stock market. They have boards that are there to act on the behalf of the underlying shareholders, which is you. And also they have those advantages that Stuart's already mentioned. So like any company can borrow from the bank to invest back into the business, that investment trusts can do the same. So they can do this leverage or gearing in the jargon. They can borrow on your behalf and boost the investments over the long term. Of course, that makes it a bit riskier if they're borrowing money. But if they can borrow at relatively good rates, which a lot of them have been able to until recent times, that has been able to enhance the returns. And you know, if you hold it over the very long term, there can be some quite nice outcomes for you.
Absolutely. And Stuart, my understanding of Alliance Trust is that you just invest in shares, stocks and shares, but could you, if you wanted to, could you invest in property? Could you invest in gold? Could you invest in commodities generally, all sorts of things?
Yeah, so Alliance Trust could do most of those things, but obviously we are very much a global equity investment trust. So that's our stated strategy. But yes, you're right. And conceptually, an investment trust can invest in essentially any asset class, gold, commodities, credit, infrastructure, or anything.
Vicky, I'm going to bring you in here because we're talking about products to invest in, and as we've heard, Alliance Trust, it's global equities, it is equities. What do you feel are the short and medium term view of global equities? I mean, I'm asking a big question here, I know, but I'm thinking in terms of the global economy. Are we coming into choppy waters, or do you think that the global economy is actually in a better shape than we thought it was? Oh, Vicky, you're right. If you unmute yourself there.
Yeah. If you look at the latest forecast, what we see is that expectations for growth for the world economy have come down a little bit, not very much. So the International Monetary Fund just issued its latest predictions just a few days ago. And they are worried about inflation being high. And they are also saying that really for the advanced economies, the prospects are worse than they thought originally. There's quite a lot of improvement in emerging markets, even though there are serious problems with sovereign debt in many countries, but nevertheless, I think growth there will pick up, and we've seen China perhaps doing considerably better than was anticipated originally for 2023, and already we've seen some data coming out that suggests that this is indeed the case. But the real question mark about stocks is really what sort of growth is there going to be in different parts of the world, and also if we're looking at particularly the developed world, what will happen in interest rates. So the trend in interest rates has been upward until recently, as we have seen, but the expectation now is, and that of course affects very significantly how stock markets behave. So this very substantial, very sharp increase in interest rates we've seen has affected stock markets internationally without any doubt. And so if you're looking at prospects ahead, the question is whether we're reaching a peak in those interest rate increases, or whether we're still in for more rises to come, particularly given that there are all these meetings happening in May by the very central banks, the big central banks, that will decide what next.
Well, there's a lot there, I'm sure, Stuart, that you are looking at yourself. This is probably something you deal with on a daily basis, isn't it? When you're choosing, because you are a portfolio manager, when you're choosing which global stocks to pick.
Absolutely. You have to be able to invest in companies with an awareness of all of the issues that Vicky was just touching on there. So obviously, no company operates in isolation. This is a very connected world that we live in nowadays. So what's going on in the global economy affects pretty much every company. So yes, we have a lot of discussion about all of those issues when looking at the managers to select to pick our stocks for us.
I'm going to take some questions in a minute, but Stuart, just before we do, I'd like you to blow your own trumpet, because I know Alliance Trust actually did pretty well last year when an awful lot of other funds went, let's be honest, particularly some very well-known investment trusts as well. So what do you think it is about Alliance Trust that has enabled them to weather those storms and do pretty well when others have done extremely badly, as it happens?
Yeah, well, I think the main thing is diversity in approach. So normally when you pick a product to invest in or an investment trust to invest in, they normally have one investment strategy. And that strategy comes with a particular set of biases or some investment style. So they might have a bias towards growthier technology companies, for example, or they might have a bias to European smaller cap companies, whatever it might be. The Alliance Trust approach is very diverse. We pick lots of different managers with different approaches, and they all pick their stocks in different ways. So that level of diversity in how they think about investing gives the portfolio a lot more robustness, shall we say, versus a typical, one standard approach. So that level of diversity, I think, is key. So when you have events like we've had in the last few years, where technology companies, particularly in the US, have been on an absolute tear for a very long period of time, and everyone thought that these companies were just going to keep growing to the moon. They went through, as you said, a pretty big reversal last year. So if you've got a strategy which focuses purely on them, that's going to be a very difficult environment for you. Whereas Alliance Trust, because of that diversity, has a lot more robustness embedded in the strategy. So when the markets change, we've always got ideas that are going to benefit from that new environment. So that's why Alliance Trust has been able to do well through different periods of time. No matter what's part of the market's in favor at any one period of time, Alliance Trust is always able to sort of find a path through the noise and deliver good outcomes through that process.
Excellent. So it is essentially, as you say, that old adage of diversity. Essentially, that's what keeps everybody, most funds and most people's wealth relatively safe.
Exactly. I mean, very simply, don't put all your eggs in one basket is a well-known phrase for a reason. Most people are pretty comfortable with that idea, but actually doing that in practice is quite hard. So Alliance Trust is there really following that adage, making sure you're not overly exposed to one big risk, and making sure that actually you've got lots of opportunities in the fund that will drive returns for long periods of time through no matter what market cycle we get.
So I'm going to go to the questions that we have at the moment. So I think this is Tina D. Now, Tina says she's very worried about pension investments dropping in value considerably because she's less than 2 years from retirement. So just in terms of the economic uncertainty and possible banking collapses and the stock market, we've got a list of things to talk about there. But essentially, I think what Tina's saying is the way a lot of people are thinking, particularly those who are close to retirement. I'm going to ask all of you. I'll start with Moira. Moira, what do you feel? What are your thoughts hearing about Tina's worries?
I think she's entirely normal in what she's worrying about, because as soon as people approach retirement, they're thinking, this is it. I'm not going to be earning anymore. And, the worries start to creep in. So I think whatever the stock markets were doing now or the economy was doing now, you would be feeling worried about your money as you approach retirement. It all really depends what you're going to be doing with the money to generate a retirement income. So if you're thinking, I don't know how old you are, but you're thinking you're going to take your money and buy an annuity, so that they sort of buy a guaranteed income that's going to last for life. If your money falls in the next 2 years, you won't be able to buy as much. But if you're going to draw your money from your pension directly as income, you're going to be keeping it invested. So if the money if the stock market did fall over the next couple of years and you drew an income, your money's, there's still time for it to grow back. Most people are looking at 20 to 30 years in retirement these days, potentially. So there's loads of time for investments to come back, even if they fall. You may be doing a combination of both. Lots of people do. They buy a bit of secure income to go alongside their state pension, and then they invest some of their pension as well. So you get the best of both worlds. Good luck to you, though.
That's very helpful. Thank you so much, Moira. Vicky, I mean, what Tina points out to, as Moira says, is the sort of thing we're always thinking, I think, at that stage of life. But do you have a view? I mean, would you say to Tina, put off retirement for another couple of years, or is she just as well to take that retirement at that time, do you think?
Well, the first thing to mention is that, of course, what you can put aside now for your pension and not pay tax has increased, as we know, because the Chancellor announced changes over that in the budget. So your lifetime pension allowance has gone up, and that's good news. And also it has allowed people who hadn't perhaps put enough money aside to supplement that by paying more every year. So that's also good news. But of course, what we don't know is whether a new government, if there is a new government after the election, is going to change that. And of course, the Labour Party has already said they're going to go back to where it was before. But of course, remember that it is the Conservative and coalition government who brought it down from where the Labour Party headed originally. So, you know, these ups and downs are not very good for making any long-term plans, frankly, but there is going to be a little bit of catching up to do over the next perhaps couple of years when people try and improve their own financial position. And I think that probably makes a huge amount of sense, and then retire if you want to then. But there is no doubt that people got worried about the pension industry overall when we had the mini budget back in September. And of course, you know, what seemed to have caused quite a lot of that is the movement in interest rates. As I mentioned earlier, very sharp increase in interest rates and yields going up. And because pension funds were involved in what is called liability-driven investment, they were borrowing funds, offering collateral to invest further and have better returns for the future for their pensioners. They were caught out by the fact that interest rates did indeed rise so substantially. They had to put more collateral, so they had to get rid of their bonds that they had on their balance sheet, and those bonds, of course, had fallen in value. So what the government is doing is looking at that again in terms of sort of, if you like, offering some stability for the future. So perhaps some of those worries that have just been expressed may not be that great in looking ahead, and a lot more liquidity to the pensions industry with a special fund that was being set up. And of course, the government also intervened at that time, buying bonds and bringing some of those yields down. So there've been some improvements on that. But also one other interesting thing, of course, when interest rates are very low, the discount rate that's being used suggests that, you know, pension funds liabilities are very high, and some of the deficits then become quite significant, and they need to find ways of making up for them. With interest rates actually rather higher now, quite a lot of those deficits have turned into surpluses for some of the pension funds. So we're not in a very bad position. So I would suggest that perhaps the worries we have at present about pensions in the future are probably a bit exaggerated, and that the government, at least the financial authorities, are onto it to make sure that things are okay as we move forward. I can't guarantee it, but obviously it's coming under the spotlight, and that's good news in many ways, because it means that perhaps things will be safer looking ahead.
Oh, well, that is comforting. Thank you, Vicky, because I do understand Tina's view. Now, Matthew has asked, is it possible to invest in investment trusts within a stocks and shares ISA? Stuart, is it possible?
It absolutely is, and I do myself. So, for example, I buy Alliance Trust shares in a stocks and shares ISA. Absolutely.
Good to know you eat your own food. That's
absolutely.
Would be a bit weird, of course, if you didn't invest in Alliance Trust. So it's very good to know that. Can
I add that
sorry,
if you when you do invest in an ISA and you buy investments to hold in it, quite often there's a way to gradually drip feed your money into the investments, and this applies to investment trusts too. So you can usually set up on the platform to gradually drip feed your money in. So rather than putting it all in one lump sum and wondering whether it's the right time to invest now or not, you can spread your investments out over a succession of months.
Oh, good point. Yes, thank you very much, Moira. Very good point there. Now, Carl has asked, can you explain more about Alliance Trust status as a dividend hero? Of course, the Association of Investment Companies has put Alliance Trust as a dividend hero a few times. I know. Why are investment trusts able to pay generous dividends? So, Stuart, let me know.
Yeah, so again, this comes back to the structure of the investment trust versus a more normal open-ended fund. So earlier on in the call, we were talking about leverage being an advantage. We talked about there's a board of directors looking out for the needs of shareholders, which is an advantage, and keeping costs low, for example. Another key advantage is the company's ability to smooth dividend payments, if you like. So the investment portfolio, for example, owns some companies, and those companies pay dividends. So those dividends might get paid out to you as a shareholder. But when you go through particularly difficult times, like in coronavirus, for example, all the companies were short of cash. So dividend payments dropped considerably. Now, if you're an open-ended fund, then your dividend to your investors also drops. But for an investment trust, they can continue to pay out a dividend because of the structure, because it is just a company in its own right. So it can pay a dividend using some of its built up reserves. And that's why investment trusts have this ability to continue to pay increasing dividends over time. And Alliance Trust itself is a dividend hero. So that means it's been paying dividends for a very long period of time. It's 56th year, I think we hit this year, of consecutively raising that dividend every single year for 56 years. So it's been able to do that by having a long-term investment approach, by having robust cash flow and returns coming from the underlying portfolio, and using the investment trust status to be able to pay out dividends through reserves when needed on the odd occasions when dividend income is actually lower than expected from the portfolio.
So you're saying that with open-ended funds, they can't actually put money in reserve, whereas for a company, you can. Exactly,
yeah. That's more of an accounting thing. But yes, ultimately, the company can choose to pay out whatever dividend it chooses to do within certain rules and parameters and regulations. But yeah, an investment trust company will pay out a dividend using some of its reserves if it needs to. Normally, it will just pay out of the income it generates from the portfolio, but it has that ability to top it up from reserves.
Moira, when it comes to dividends, I'm a big fan of dividends, and obviously dividends, as everybody, I'm just explain for a moment, it's sort of kind of like profit share, if you like. When a company does well and it makes a profit, it can, if it wants to, give some of that profit to its shareholders, us, and that can be really very helpful. Nice thing to live on for some people. But isn't it also quite a useful thing to reinvest dividends if you're looking for growth, Moira?
Yes, it depends what life stage you're at, or what your financial goals are at the present. If you're looking for income, getting a collection of investment trusts who are paying out dividends to you is a brilliant thing. If you're looking to grow your money for the very long term, reinvesting those dividends to buy more shares in the underlying investment trusts is a good idea. And you can do that automatically through most of the platforms. You can just set it up so that every time a dividend comes in, it's automatically reinvested in the underlying shares. And that compounding effect on the investments of reinvesting the dividends can be really powerful over the long term. But I would say, the dividend heroes, I'm a fan of the dividend heroes. I think it's a great initiative. If you want to find out more about them, you go to the Association of Investment Companies website, and they've got the list of all the ones that have the longest track records, including Alliance Trust. And I think, for any trust that does have a very long track record of increasing their dividends every year, they're not going to want to break that. It's very important to them to keep increasing it. Now, whether they increase a dividend in line with inflation is another matter. But not all will be increasing it in line with inflation, but at least the direction is up.
Yes, absolutely. Yeah, as I say, I'm a big fan of dividends, but it's very much a case of you sort of have to look at the past, and you hope that they're going to continue to give out. There's no guarantee that any company, whether it's an investment company or an ordinary company, will continue to give dividends. I mean, but there are some, as you say, that have done it for a long time. And as you say, it would have to be a major change in policy to stop them. So you've got a sort of semi-guarantee. There are other companies, aren't there, Moira? I mean, ordinary companies. I'm thinking Marks and Spencer's. I think at one point EasyJet was quite good for dividends. Any other companies that you would recommend, Moira, that have long histories of dividends?
Well, I mean, I like the investment trusts. I mean, I invest in investment trusts myself, and there's Alliance Trust is obviously one. I think F&C Investment Trust, which is the oldest one, has a great track record. City of London, bankers, etc. There's lots of different ones, and some of them invest globally, some of them invest just in the UK, because of course the UK is a great source. Stock market is a great source of dividends. Some of the big companies listed on the London Stock Exchange are really good.
Because I'm just thinking, I was thinking of companies like, as I say, Marks and Spencer. I think in America, Johnson & Johnson's known for its dividends. You know, there are a few of these that are other companies. But yes, Alliance and Trust having 56 years of solid dividend payment is a really impressive thing, I think, Stuart.
Absolutely. It's a trust with a very long history and a very long history of paying increasing dividends to shareholders. And we know that, those dividends are a meaningful part of investors' total return and how they use their investments to fund their retirement. So it's very, very important, as you said, and one that the company is very committed to continuing, as Moira indicated. It's not something that anyone will give up lightly at all.
No. Now I've got a question from Randy Rizzi, which is, need more explanation, please. Okay, you need to tell me what you want more explanation on, and we'll do it. Definitely. Send us another note, Randy. Now Rebecca says, how do you invest into Alliance Trust? Is it a share you purchase? So Stuart, could you explain how do you physically actually buy, invest into Alliance Trust?
Yes, so it is just a company share, like any company, be it Vodafone or Amazon or Microsoft or something. It's just a company. You can buy it on stock exchanges. If you go to the Alliance Trust website, we do have a page on how to invest. So obviously through any typical platform that you might use for your ISAs and other investments, they will be able to buy shares of an equity like Alliance Trust.
Great. And got Isabel is asking, could you explain more about what dividends are? Moira, could you explain? You do a better job than me, I'm sure.
Well, I hope so. I don't know if I will. So yeah, a dividend is a payment from the company to its shareholders. They're usually regular, so they're once a quarter. Sometimes it's monthly, sometimes it's every half year or even annually, but it's regular and it's going to come in on a certain time at a certain date. And it's just it's a way of rewarding the shareholders for investing in the company. Of course, the other way you get your reward is through the value or the price of your shares increasing over time. And I just think there's something to make sure you think about when you're investing, because you could invest in a company that doesn't pay dividends at all. And then you would be reliant on the share price just going up over time to give you a decent return. But if you invest in a company that pays dividends, you're going to get that regular income coming in. You might also, hopefully you will, get an increase in the share price along the way as well. So you get both things acting in your favour over the long periods of time.
Thank you. And now I've got a question from Callum, who says, well, there's a comment really, says the government and the financial authorities sanctioned LDIs for pensions in the first place to make sure everything is okay. Vicky, do you have a view on that?
Yes, I think Callum is absolutely right. Of course, those investments, if you want to call them that, were used in a way to hedge against interest rate changes. But of course, those interest rate changes that we have seen were so enormous in terms of the changes that were taking place. They may still be negative in real terms, but the change was very significant, and that was not anticipated. And I think that's basically where we are. Yes, any way of hedging is generally encouraged, or was generally encouraged, but the way that this can operate in practice when you have a shock was probably not quite understood by the authorities or anyone else. And I think the period we went through since the mini budget has put a lot of light on that, and rethinking is taking place, as I said earlier.
I saw you nod your head, Stuart, at that comment. Do you have a view on this?
Well, I mean, look, it's a very technical area, so I'm not sure how much to get into it. But yes, I mean, as Vicky says, these LDI strategies were designed to protect the pension fund. So it's trying to match your pension liabilities to the assets that you've got. So as Vicky described, it was a sensible strategy, but the speed at which the market changed was the real factor, I think, in causing stress in that system. It's not that the system didn't work, but the speed of that change required a lot of cash flow in a very short period of time, and that created a lot of stress, really. So I think that's the issue, but it's quite a technical area to get into if you'd like to.
Yes, what does LDI stand for?
liability-driven investing.
Ah, right. Yes. So they need to have a particular proportion of, as you say, assets in order to make sure that it's all shored up, you would hope.
Yeah, it's about this idea of matching your assets to your liabilities. So if I need to pay £100 in pension payment in a few years' time, I need to have the assets today to pay that payment in the future. So the assets required today will change depending on the interest rates and the investment returns you expect. So that's what it's trying to do. It's just trying to match today's assets to your future liabilities.
So what the pension industry was doing was basically borrowing to invest more in particularly long-term government bonds. We're talking about really long-term government bonds here. And in order to make up for whatever losses they thought they may have in the future, in order to indeed, as Stuart was saying, balance their liabilities and assets. That was what was going on. And of course, they have to have some sort of insurance against it. But whatever it is that they had been involved in on this hedging was not capable of responding, if you like, or covering this very substantial change that took place in interest rates that we saw. And the interesting thing about this increase in interest rates is that it has affected financial institutions across the world, and that is what happened with Silicon Valley Bank. That's what's been happening with some other smaller banks in the US and regional banks in the US, which were not as regulated as the bigger institutions were. And because, of course, what's been happening in the bond market, we have loads and loads of unrealized losses lying in the balance sheets of quite a lot of the bigger banks as well. But at least there's a different accounting rule that goes for them, and we are aware of this, whereas we were not really quite aware of this as we saw with the crisis, if you like, in the US, where in the end, the authorities had to step in and guarantee all the funds so that the moment of course, those banks collapsed because everyone just withdrew their funds thinking that there was going to be a serious problem with the ability of the institution to meet their obligations, and the authorities had to step in and guarantee them all. So this is why there is also now a rethink of what size of deposits will be guaranteed even in the UK in the future, to make sure that this huge movement in funds that can happen just like that because of electronic transfers these days can be stemmed if there is a crisis again.
I have heard, Vicky, I mean, we're going off topic a bit, but I've heard, Vicky, that central banks around the world are, I mean, this is rumors, that they're getting together and deciding to guarantee everything. I mean, like with SVB, where it was supposed to be $250,000 that was guaranteed, but it ended up being everything that was paid in, that they're going to do that with all banks. I mean, that sounds crazy to me. Do you think that's a possibility?
Well, any increase in deposit insurance will have to be paid for by the financial institutions themselves. So this is where they're putting their money into a deposit insurance fund to make sure that this happens. So obviously, if you're guaranteeing everything, it's going to be incredibly expensive at the end of the day. It's going to have to be the taxpayer who foots the bill, which is exactly, of course, what happened with the financial crisis at the end of the day. And look what's happened with Royal Bank of Scotland coming into state hands and everything guaranteed that was in there. But of course, we are off topic slightly, but we're talking about investing, and we do know that a particular class of investors in big banks like Credit Suisse were left very out of pocket by the fact that the rules suddenly changed, and they were the last in the pecking order of who survived and who got any money back from what happened with Credit Suisse, for example. So whereas shareholders who normally are the ones that lose out completely were at least left with some haircut, lower value, but at least they got something back from the UBS Credit Suisse purchase. So yes, there is a lot, I think, that needs to be sorted out, and you're right to be highlighting it. How we'll end up is not very clear, but if we move in the direction that you have heard we may be moving, then I think we just have to accept that there's going to be this huge impact on our overall debt to GDP ratio at some point, because you'll have to put something aside to in your calculations of what the public sector contribution might be in anticipation of something going wrong.
Higher taxes, lovely. Thank you. Randy's asked, can anyone benefit from this, and are there any qualifications for investing in a investment trust? There aren't really, are there? I mean, are there any age ranges or anything like that, Stuart?
No, I mean, anyone can invest in investment trusts. No qualifications required, but investing is a difficult challenge for everyone involved. So always being able to understand what you're doing and being comfortable with the risks involved is the key. But anyone can invest in investment trusts.
And I assume that the best way to do it is to open an account with an online broker like AJ Bell or eToro or Best Invest or one of those. And then you look for the Alliance Trust symbol. What is the Alliance Trust symbol?
ATST would.
ATST. Okay, so the symbol that you look for on one of these platforms would be ATST. And then you open that and you can do it, as we've said, you can do it in a stocks and shares ISA, and I would, if you have the space so that you don't have to pay tax on the gains, or indeed you could have it in your SIP, I assume, in your pension SIP, your personal pension, if you wanted to.
Yep. That would be possible. It's always worth saying that people should get some advice on how best to do things from their specific perspective. But yeah.
Yeah, good point. So if you don't have a financial advisor and you'd like one, there's a really good website called vouchedfor.com, which has lots of financial advisors and their sort of references, if you like, from former clients. So that's worth having a look at. Raj, you said, you didn't quite catch the website showing the dividend heroes. So that's the Association of Investment Companies. Is it aic.org.uk? I think, or .co.uk. Stuart, you weren't, or Moira, yeah.
I've shared the website on the group chat.
Oh,
so
good.
hopefully you can all see it there.
So it's the AIC. Excellent. That's really helpful. Thank you. Oh, yes, I see what you mean. It's the Association of Investment Companies website. Excellent.
Yeah, and then I've put the link on it in another comment as well. So hopefully you can all copy
and
that.
Alliance Trust is regularly on that, which is, a good thing to have, I think. So Claire, you're saying, thank you for making this understandable to a complete novice. Oh, anytime, Claire. That's good to have that. And thank you, Moira, for putting that link there. So also, yes, thank you. Now, Michelle is wanting to know, saying, I work for myself through a limited company and do not invest in a pension. So far, just have savings accounts and a cash ISA. Would I be better off investing in a pension first, but before investing elsewhere? Elsewhere, or do both? Yeah, interesting. Now, Moira, I'm going to ask you first. What are your views on that?
So a lot of people unfortunately keep too much money in cash and savings, and even it's a very prudent thing to do. At the moment you might be getting fairly decent rates on that money, but you won't be beating inflation, I guess. So I think the first thing is to think about how much cash you actually need. You need enough for your emergency fund. You probably need enough for 6 months of living expenses if something went wrong and you weren't able to work, particularly as you're self-employed. And then any money that you could afford to stash away for 5 years or more, I would get that working harder for you. I would get that invested, because 5 years gives you enough time to ride out some bumps in the stock market, and is usually the length of time financial advisors tell you to invest for at least. Even better if you can stash it away for 10 years, of course, because then you've really got the power to grow that money. But yes, pensions are a brilliant way to invest. You will get income tax relief on the money that you put into your pension, so it's like getting free money from the government, and it's a really great boost. As soon as you put your money in, you get the income tax relief. Some of it you may have to claim back through your annual tax return as well, but your accountant you use for your self-employment should be able to tell you how to do that. The thing about putting money in a pension is it's locked away until you're at least 55 though, so you won't be able to get hold of it until then, so you have to be really prepared to lock it away for that length of time.
Thank you so much. I agree, because pensions, the useful thing about pensions is that you get the tax back. And of course, if you are working, if you're employed, if you're on PAYE, you should be having a pension from your employer. And the great thing about that, of course, is that your employer puts money in as well, free money. Fabulous. I've never had that because I'm freelance, always been freelance. So I've never had that. I give it to other people because I have employees. So I do think, you know, grab it with both hands. But if, like me, you're a freelance, then a SIP, as I've mentioned before, a self-invested personal pension, SIPP, is a really handy vehicle to use. And you can then either run it yourself if you're feeling clever, or get somebody else to run it for you. And there are various platforms like, you know, we've mentioned eToro and AJ Bell, Hargreaves Lansdown. They do sort of off-the-shelf self-invested personal pensions, which is kind of not the point in my view. But, you know, if you're going to have a SIP and you'd like someone else to do it for you, then that's quite a handy way of doing it. And Stuart, if you have a SIP, you can include Alliance Trust in it quite easily, couldn't you?
You can indeed, yeah. It's a good way of getting exposure to, you know, a wide variety of different investment strategies and equities without having to pick them all yourself, basically. Yeah,
exactly, which is a nice way of doing it. Now, who was this? Rashi says, is this in crypto investment? No, I don't. Stuart, are there any? There aren't any investment trusts that would include crypto. I mean, you're just not allowed to, I assume.
Yeah, I can't speak for every investment trust in the world, but not that I know of.
No, I was going to say it is. I mean, I would think, like you, that the majority of investment trusts invest in equities. Do they? I don't know. My assumption is that it is more equities than anything else.
Yeah, that's probably true, but there's definitely a lot of investment trusts around investing in other mainstream asset classes. So it might be the majority are equities, but there's certainly a lot of other asset classes there too. I'm just not sure they go as far as the esoteric asset classes like crypto and things like that.
Yeah, exactly. I mean, obviously, Alliance Trust has been going for decades. It's about 100 years old or something, isn't it now?
Yeah, I think 1888 was when it was founded.
Wow,
so
even more. Yes, getting to 150 almost, you know, not long. So the assumption, my assumption is that you just kept to equities because it's good to have a spread, but not too much of a spread. So you're keeping with equities so that's one discipline over the whole world.
Yeah, I probably can't speak to the full history of the trust, but we've certainly been managing it since 2017 on the basis of it just being, you know, purely focused on global equities. So it did have some other types of assets in the portfolio in the past, but those have been disposed of now. I mean, I think, you know, the rationale for doing that and just focusing on one asset class like equities is, you know, as you say, wanting to be, you know, an expert in the field, essentially. You know, this is an active management process. In the context of active management, you are competing against all other investors that are out there. So you've got to be, you know, very much on top of your game and doing something different from all the other investors to be able to outperform all the other investors.
Yes.
And I think it's very hard to do that if you're investing across all asset classes. There's a lot of expertise in different areas that are, you know, required to be different in different asset classes. So I think it's very hard for someone to be the best in every possible area. So that's why we focus just on equities. We think we've got, you know, strategic added value that we can bring in this area. So that's why we focus on global equity space.
Yes. Claire has said, could we potentially do a meeting like this on pensions? Yes, we certainly could. And I think, as Izzy said, we do have plans because pensions is a huge subject and affects so many of us. So yeah, we'll definitely do a webinar on that. And I have another question for you, Stuart, because that's about the fees that investment trusts charge, and particularly that Alliance Trust charges, because this is something that I think a lot of us as investors, we forget about. You think, oh, look at the growth, look at the dividends, and we forget that you have to include the fees, the charges. So what are the fees that Alliance Trust charges?
So the fees on Alliance Trust are around 0.6% per annum. So they're pretty competitive against most other investment trusts and other open-ended companies. And again, going back to one of our earlier questions, you know, one of the advantages of investment trusts is they can offer pretty compelling fees versus most other open-ended funds. You know, again, they've got a board of directors whose job it is essentially to look out for shareholders' interests and make sure those costs are kept as low as possible. I'd also add that in the case of Alliance Trust, because we run a multi-manager fund, you've got myself, who works at Willis Towers Watson, managing the company, we're picking the stock pickers, but then you've got around 10, say, underlying stock pickers picking the company. So you've got lots and lots of people involved in building the product, building the portfolio, and picking all those companies on your behalf. So the problem with those types of strategies typically is that there's a lot of costs involved with having lots and lots of people. And that makes these things very expensive. So the reason Alliance Trust is actually pretty competitive on its fees is that, you know, the scale that we have as a global investment business and the scale that Alliance Trust has alongside our other client base is we can negotiate with managers and drive down all those costs, and not just in the stock pickers, at every aspect of the food chain, if you like. We're just driving costs down as much as possible. And that's, you know, that's always an ongoing process, but that's why, you know, we think this is a pretty competitive fee for what is, you know, a very active strategy with lots of diversification built in.
Moira, one of the questions that I quite often get from readers about investing is what sort of percent, and this is a huge question, I know, but what sort of percentages should people have of their money in cash? What percentage in a pension? What percentage in investments? What percent, you know, these sort of things. I mean, it does change depending on what stage of your life you're at, doesn't it?
Yes, it does. I think the middle ground that most people start from is what was traditionally called the balanced portfolio. And it has lots of fans still. Not everybody's a fan of it, but a balanced portfolio has 60% in equities and 40% in bonds. And that is sort of like the middle ground for somebody who wants to take an average amount of risk and grow their money. Now, if you're younger, or if you're feeling like you can cope with more ups and downs in the stock market, you would add a greater percentage of equities. So you might have 80%, 90%. If you were 21 or 22, maybe 100% in equities. Yeah. If you were feeling really that's a risk averse or worried, like the lady earlier who asked the question about approaching retirement, you might want to reduce the equity exposure in the portfolio down to 40% or 30%. And so that, you know, you can change this as you go through your investment life cycle. You can pick moments to reduce exposure. You can add in other things that aren't equities or bonds. You could add in gold. You could add in commercial property, private equity exposure, which you can get through some investment trusts. And so therefore you end up with this, you know, diversified, not all your eggs are in one basket, but it all makes sense kind of portfolio. That helps.
Actually, Vicky, as Moira's talking about, as we always do say this, you know, the mixture between stocks and bonds. What about the bond market, though? Because I'm hearing so much about, you know, of concerns about the bond market, which, as we know, is massively bigger than the stock market. What do you feel? I mean, I'm talking generally, you know, again, the global market for bonds. What are you feeling about that?
It has been very volatile, of course, because of the increase in interest rates we've seen, generally inflation going up. So in a way, investing in bonds hasn't been particularly good just very recently, even though the financial institutions have generally been encouraged to have, particularly since the financial crisis, a bigger share of what they hold in bonds. And with quantitative easing that we saw for a large part of the last 10 years, there is no doubt that lots of bonds have been held by financial institutions. And one of the problems we've seen recently with the sort of mini banking crisis, if you like, if you want to call it that, is because of those holdings. So although, yes, in the long term, bonds make huge amount of sense, we have to be aware that they also can go up and down in value very significantly, just like stocks can as well. And Moira mentioned the property market. Of course, we've seen problems with the property market, particularly with open-ended funds, where, you know, in some cases we've seen sort of redemptions being stopped temporarily because, of course, people were beginning to worry about the drop in prices taking place there as well. So you have, you know, basically dangers everywhere. So as Stuart is saying, in terms of being able to spread your risk across is obviously very significant. But I was just thinking about pensions. There's one thing to add, and whether one should be investing in pensions now. Of course, it makes sense, particularly if you can take it out at some point, depending what type of pension you have, and invest it. Although there've been lots of mishaps with that too, some scandals about where people put their money when they took it out of various pension funds and then lost a lot of it. So one has to be very careful and get the proper advice in terms of what you do with it. Obviously, that's probably why we're having this event right now. But of course, the pension age is increasing. Yes, perhaps the further increase to 68 has been put back because it looks like life expectancy is going backwards. But we now have many, many years to go before you reach that retirement age from when you can seriously reap the benefits, unless, of course, you take your money out and start investing it in a sensible way slightly earlier. So there are all these issues that will need to be looked at. Now, looking ahead, yields have been coming down in the last few months, and so we may get back to something more normal, and the International Monetary Fund is forecasting that interest rates would go back to pre-pandemic levels. But if you think about bonds more generally, that's short-term interest rates. Bonds more generally, we are now in a much more high borrowing environment because of COVID and the energy crisis since the war in Ukraine. So governments are going to still need to issue various bonds in order to continue to fund some of the deficits they have, or they might go the other way with quantitative tightening in particular and try and very, very rapidly. Central banks reduce their holdings of bonds, which will continue to put prices down for bonds. And also, of course, governments trying to reduce their deficits. So reducing the sort of increase, if you like, in what they were prepared to issue before. So it is an interesting market to watch. Which way exactly will go sort of remains to be seen.
That's fascinating. Thank you. I'm just seeing Carl has asked a question about Alliance Trust, by the way, Stuart, which is good point here. How does the relationship work between Willis Towers Watson, which is the company that actually runs the fund, and Alliance Trust itself?
Right, yeah. So Alliance Trust is the company. It is managed by a board of directors who are all non-exec directors, and they choose to appoint an investment manager for the company. And the investment manager is Willis Towers Watson. So I'm co-portfolio manager with some colleagues of mine at Willis Towers Watson. We run the assets on behalf of Alliance Trust. And therefore, in our case of our strategy, we're picking the stock pickers that make up the portfolio.
Oh, great. So I see your point. Yes. So you're the ones that do the work, essentially the picking. But Alliance Trust, they have a board that oversees the whole thing.
Exactly, yeah. So the board oversees us and what we're doing, and they hold us to account and make sure we're doing all the right things and doing a good job.
And of course, Alliance Trust, as we've said, it's well over 100 years old. It has a really good track record. But of course, as everyone says, past performance is no guarantee of future performance. But Moira, would you say that when it comes to actually picking an investment trust, probably past performance, particularly if it's over a few decades, is probably the best way to decide whether something is going to be good for the long term?
It's certainly something you should look at, but you should also look at whether the manager who's in place at the moment on the investment trust is the one that's delivered that performance. Because if they've just been recently appointed, they can't take any credit for that. Mm-hmm. You'd have to look at what the manager has done elsewhere beforehand. Mm-hmm. But I say, that what Stuart's just said about Alliance Trust, the board of the company appoints the investment manager. They can also get rid of the investment manager if the performance isn't good, which is a really strong thing about investment trusts. There's an independent board that can hire or fire the fund manager and make sure that good investment performance is delivered for the underlying shareholders. And I think that's fairly powerful. And over the years, you do see fund managers being fired occasionally. Yes. I think that's a healthy thing to see. Sorry, Stuart, don't make you worried. I'm sure you're in no trouble whatsoever.
Completely agree. It's a good thing.
Absolutely. And finally, I'm just looking at some other investment trusts which shall remain nameless. Each investment trust, of course, has their own plan of what they're going to invest in. And there's one that I can think of that was doing fabulously, but that was because they were investing so much in tech. So do you think that, I mean, this is to both Stuart and Moira, do you think that probably looking for an investment company that invests across the board and doesn't just focus on one particular area might be safer than going for investment companies that really do home in on what may be doing really well at the moment, but you just don't know that it will later on?
Yeah, there are lots of specialist investment companies that do focus in on niche areas like tech, like infrastructure, like even there's one that specializes in care homes or music rights. I think there's a space investment trust as well. So, you know, you can add all of that in when you get a bit more confident. I would say if you're starting out with investment trusts, go for a big global trust like Alliance Trust. There's many others. Or a UK focused trust, something that's familiar and is your home territory. And then you know, when you get more confident, you can start looking at those niche areas.
All right, we're nearly finished. I've had a question texted to me actually from Vicky, and it's, is there any risk involved in an investment trust? Stuart, what are the risks involved?
The prices can go down as well as up. That you can lose the money that you invest. And the reason you can lose money is for, you know, an untold number of reasons. And, you know, there are millions of things in the world that can go wrong. Yeah. So, you know, there's definitely risk. It's important to understand how much risk you're taking and potentially how much money you're willing to risk losing ultimately.
Because Moira, oh, sorry, carry on, Stuart.
Well, no, but I was going to follow that with saying to try and generate returns, positive returns, you also have to take risk. You don't get returns for free. No. So risk taking is important. You have to understand it and size it appropriately yourselves, but ultimately you should be taking risk in order to generate long-term returns.
Because Moira, I'm thinking also is, you know, something to be aware of for new investors is that unlike with banks and savings accounts where you have, you know, the FSCS guaranteeing things, if you lose money with an investment, you lose money. I mean, that's part of the risk, isn't it? You know, that you're going to, you hope you will make money, but you might actually lose. It's the way it is.
Yes, but I would say you don't actually lose the money until you sell at a lower price. Yes. So if you buy your investment and you keep it, things can recover. So don't rush to sell. Be rational about it. We can all get quite emotional about our investments. That's a normal thing. You've got to keep a clear head and stay with it for the long run. So preferably 5 years, even better 10 years.
I agree, absolutely. Well, thank you so much, my panel. So we've had Stuart Gray from Alliance Trust investment company, Moira O'Neill, investment writer at the Financial Times and Investors Chronicle, and economist Vicky Pryce. Thank you all of you for your contributions.